The U.S. stock market was starting to feel predictable again. Investors were getting comfortable, trends were forming, and for a moment, it almost seemed like the chaos of the past few years was finally settling down. But then, almost out of nowhere, volatility came roaring back. Stocks began swinging sharply from one day to the next. Tech companies that were leading the market suddenly pulled back, only to bounce again just as quickly. Headlines started flashing warnings, analysts began shifting their outlooks, and once again, uncertainty took center stage. So what exactly is causing this sudden return of volatility? And more importantly, what are smart investors doing right now that most people are missing? To understand what's happening, we need to start with the biggest force driving the market right now: interest rates. The Federal Reserve has spent the last few years aggressively raising rates to bring inflation under control. While inflation has cooled compared to its peak, it hasn't completely disappeared. Now the market is stuck in a difficult position, constantly trying to predict what the Fed will do next. Will they start cutting rates soon? Or will they keep them higher for longer? This uncertainty alone is enough to create major swings in the market. Every time new economic data is released, whether it's inflation numbers or job reports, investors react instantly. If the data looks positive, stocks rally. If it disappoints, markets drop just as fast. This constant back and forth is a major reason why volatility has returned. Another key factor is how concentrated the market has become, especially in large technology companies. Over the past year, a handful of big tech stocks have been responsible for driving a large portion of the market's gains. This creates a fragile environment because when these few companies move, the entire market follows. If they report strong earnings, the market surges. But if they show any signs of weakness, it can trigger widespread selling. This kind of imbalance makes the market more sensitive and more volatile than it appears on the surface. At the same time, global uncertainty continues to add pressure. Economic slowdowns in different parts of the world, ongoing geopolitical tensions, and shifting trade dynamics all contribute to a sense of instability. Markets don't like uncertainty, and right now, there's no shortage of it. Even when things seem stable, investors remain cautious, always ready to react to the next piece of unexpected news. If you look closely at the overall market, you'll notice something interesting. Even when major indexes trend upward, the journey is no longer smooth. Instead, it's filled with sharp drops followed by quick recoveries. This is what professionals call a choppy market, and it's one of the most challenging environments for average investors. It creates confusion, shakes confidence, and often leads people to make emotional decisions at the worst possible time. But while many investors struggle in this kind of environment, smart investors see it differently. They understand that volatility is not just risk, it's also opportunity. Instead of reacting emotionally to every market move, they focus on strategy and discipline. One of the most important things they are doing right now is staying patient. They are not chasing every rally or jumping into stocks just because they are trending. Instead, they are waiting for the right opportunities, knowing that volatile markets often create chances to buy high-quality assets at discounted prices. Another move that might surprise many people is that smart investors are holding more cash than usual. In a strong bull market, staying fully invested might make sense, but in a volatile environment, having cash gives you flexibility. It allows investors to take advantage of sudden market drops without being forced to sell other investments at a loss. Cash is no longer seen as idle money, but as a strategic tool. At the same time, there is a clear shift toward quality. Investors are paying closer attention to fundamentals like earnings, cash flow, and balance sheets. Instead of focusing on hype or speculation, they are prioritizing companies that have proven they can perform even in uncertain conditions. This shift reflects a more mature and cautious approach to investing, one that becomes especially important during periods of volatility. Diversification is also making a strong comeback. For a long time, many investors concentrated heavily in technology stocks because they were delivering the highest returns. But now, smart investors are spreading their investments across different sectors like energy, healthcare, and industrials. This helps reduce risk and provides more stability when certain parts of the market experience sudden downturns. Perhaps the most important mindset shift is the focus on the long term. Experienced investors understand that markets move in cycles. Periods of volatility are not unusual. They are a natural part of how markets function. Instead of trying to predict every short-term movement, smart investors focus on where the market is likely to be in the next 5 to 10 years. This perspective helps them stay calm and avoid making decisions based on fear or excitement. Unfortunately, this is where many average investors make mistakes. When the market drops, they panic and sell. When it rises again, they rush back in, often at higher prices. They follow trends, react to headlines, and let emotions guide their decisions. This cycle of fear and greed is one of the biggest reasons why many people struggle to build long-term wealth in the stock market. So what should you do in a market like this? The answer is simpler than it seems, but not always easy to follow. First, accept that volatility is normal. It's not something to fear, but something to understand. Second, focus on quality investments rather than short-term trends. Third, keep some cash available so you can take advantage of opportunities when they arise. Fourth, avoid making emotional decisions based on daily market movements. And finally, think long-term. The investors who succeed are not the ones who react the fastest, but the ones who stay consistent and disciplined over time. The truth is, the U.S. stock market is not broken. It's evolving. Volatility is simply a reflection of uncertainty, and uncertainty is always part of investing. The difference between success and failure in times like these comes down to how you respond. While most people react emotionally, smart investors stay focused, patient, and strategic. And in the long run, those are the ones who come out ahead.